Ended.
We are live, please go ahead.
Sundaram, please share the welcome address from ASSOCHAM, sir.
So, good afternoon, everybody. Good afternoon. Is everybody here?
You're audible. You can go ahead, sir.
Good afternoon, everybody. I am Sundaram, Assistant Director with ASSOCHAM India. Today, we are going to discuss about 2020 and its tax implications. Now, we have a panel here. Raghavan. So Ravi Raghavan is a senior partner with Lakshmi Kumaran and Sridharan. Currently heads the indirect tax practice of firm at Bangalore, and he has been handling the indirect tax vertical within firm during the past 18 plus years. Now he has, he assists clients with advisory work to ensure compliance of the indirect tax law, and he has a rich experience and presence. Also, he represents the clients before various quasi-judicial and judicial bodies, including the commissioners and tribunals. Now, he has expertise in handling complex indirect tax issues involving classification, valuation, input tax credit eligibility, etc. Both as a part of litigation and advisory practice involving multinational companies, large domestic companies, including all the major public sector companies. Today, we also have the fellow panelists along with Ravi Raghavan is Ms. Neetu James, Partner Direct Tax, Mr. Brijesh Kotari, Joint Partner GST, Mr. Kalirajan D, Principal Associate Customs. Now, I welcome all of you to this event, and for finer details and discussion on this subject, I invite Mr. Ravi Raghavan to take the dais. Thank you, sir.
Please unmute yourself.
Thank you, sir. Thank you for your warm introduction. Good afternoon, ladies and gentlemen. We thank you for joining us for another session on the analysis of the budget 2022. We will be discussing the changes which have been proposed in the finance bill of 2022, mainly relating to customs, GST, and also direct tax. As Mr. Sundaram introduced, I have my colleagues Neetu, Brijesh, and Kali Rajan, who will also be joining me in deliberating on the various changes which have been made in the budget 2022. We start the discussions today with the proposed changes under the customs law. Am I audible?
Yes, sir, you're audible, sir. The video is not.
Okay, I'll just. Seem to be some issue. Good afternoon. Sorry for the inconvenience. There's some problem. Am I audible now?
Yes, sir. Yes.
Yes, sir. Yes, you are audible.
Yes. We will start today's presentation with the changes in the customs law.
Sir, before
I
that,
think that
I lost the sharing options. Hello.
Seconds.
I'm just sharing, sir. I'm just not.
yes, we start with the changes in the customs law, followed by the changes in the GST law, and we will close it with the changes in the direct tax law. Under the customs law, one of the major changes, as most of you are aware, and it's sort of a much awaited change. Kali, if you can just move to the next slide. This is what we intend to cover. Basically, the amendments under the Customs Act, the amendments made to the IGCR rules, they intend to make it a fully automated system, etc. Much awaited clarification on the social welfare surcharge, which in fact there are investigations which are already started from number of jurisdictions proposing to demand the social welfare surcharge even where the basic duty was nil. There is a recent favorable clarification that has been issued. We will briefly also touch upon the proposed changes in the customs tariff and the rates, and the phased manufacturing program with the government's award objective of Make in India and promoting local manufacture. We will also be touching upon this particular program of the government, PMP of the government. Starting with the amendments in the customs law. One of the important amendments which was much expected is the jurisdiction of the officers of the DRI, the investigation, the intelligence, etc. Most of you are aware, recently there has been a Supreme Court judgment in the case of Canon India, which clearly held that the term the proper officer under the customs law will not include the officers of the Directorate of Revenue Intelligence. And therefore, this judgment in fact followed the earlier decision in Syed Ali. They also considered the Delhi High Court judgment and held that once the jurisdictional customs officer has undertaken the assessment, then he will only be the officer who has the power to issue show cause notices subsequently. And the officers of the DRI will have no power to issue show cause notices. Hence, the show cause notices issued by the DRI were held to be not valid without beyond jurisdiction and were quashed. Now, based on this judgment of the Honorable Supreme Court in Canon India, there have been a series of different high courts which have followed the decision and taken a view that the show cause notices issued by DRI not being proper, the various proceedings, demands, etc. were all set aside. In fact, the tribunal also has been following suit and has disposed of a number of appeals of late, holding that the show cause notice issued by DRI, the demands confirmed based on those show cause notices are not sustainable. Now, in view of this development and the judgment of the Honorable Supreme Court in the case of Canon, which has been subsequently followed in another case in Agarwal Metal, the industry and we were also expecting that the government is going to act upon this because there are thousands of crores of revenue involved in such show cause notices where DRI has been involved and issued the notices. Matters pending in the pipeline before different authorities, some at adjudication, some at appellate stage. And people have also approached the high courts challenging the show cause notices in writ. Now, what the department or the government has done in the proposed in the budget is to make changes in the relevant provisions of section 234, which gives the definition of the proper officer. Make again suitable amendments in section 3 and also section 5, thereby including the officers of the DRI, the investigating authorities, etc., as the proper officers for the purpose of the Customs Act. New subsections have been inserted in section 5, providing the powers of the officer of customs, and also the board has been empowered for assignment of such functions to the officers of the customs. The intention by way of these amendments is to have the officers of the DRI also as the proper officers, so that they are empowered, or the show cause notice issued by them for the past periods are deemed to be issued under the valid provisions, amended provision sections. Section 4 widely also outlines the criteria for the board to consider during the course of assignment in terms of section 5. These are various criteria in terms of which they can assign the functions to the officers. Now, what these amendments have been done, and also section 96 of the Finance Bill, clause 96, validates these amendments and seeks to retrospectively validate all the actions taken under the Customs Act. This clause 96 of the Finance Bill 2022 thus provides or validates the various actions taken by these officers, and the validation also stipulates that the newly amended provisions of sections 2, 3 and 5 will be deemed to have the effect for all the purposes as if all these provisions were there at the relevant points of time when the show cause notices have been issued. What is the impact of these amendments under the Customs Act? Does it mean that these amendments have overcome the Supreme Court judgment in the case of Canon? And consequently, does it mean that all the actions of the show cause notices which were issued by the DRI have been validated, and therefore they will be deemed to have jurisdiction at the relevant points of time? That's a big question. Though prima facie it seems that these provisions have taken care of the Supreme Court judgment on the issue of jurisdiction, there are definitely still some open areas as to whether these amendments can be considered as retrospective or not. Is the validation that is done, is it relevant or not? That seems to be the intention of the government. According to us, some of the provisions is prone to challenge. Definitely the assessees are going to challenge. This has been the situation in the past also, when amendments were made retrospectively validating these earlier provisions or to overcome judgments of Honorable Supreme Court. We have seen a spate of such litigations challenging the validation itself. Though the courts have taken divergent views on these aspects, we need to see how this amendment will be taken care of in the courts. So matters which are pending already, there can be an issue of filing additional petitions, bringing on record these amendments and the proposed action by the government. The amendments which have been made in terms of sections 2, 3, 5 and 6, 4 and 5 are all basically to take care of the past actions, and that is why clause 96 of the Finance Bill 2022 validates all these provisions. Now in the budget, a new section 110 AA has also been issued, which again is a fallout of the judgment in the case of Canon. In terms of this new section 110 AA, going forward for the future, the customs officer other than a proper officer cannot issue a notice for demanding duty. If you read this provision, what it says is that the officers who are undertaking the investigation or who undertake the audits, their role will stop once they complete the investigation or the audit. Once their role is stopped, these officers will have to give a report to the jurisdictional customs officer, who will then issue the show cause notices and then take over the adjudication and the other proceedings. What this provision therefore does is that the officers who are entrusted with the role of investigation and audit, what they will do is only provide a report of the investigation to the proper officer, who will be assigned as the function under section 5, who has to then take over and do the assessment, the adjudication and the assessments. So this will be only for the future. Does it mean that in terms of this new provision, the government accepts that the judgment of the Supreme Court in the case of Canon was the correct position at that point of time? Therefore, for the future, they are going to only ensure that the customs officer who undertook the initial assessment would only be the authority who will issue notices and thereafter take up adjudication, thereby ensuring that the officers of the DRI would no longer be empowered to issue notices, nor will they be empowered to adjudicate any such show cause notices issued by them. So this investigation officer therefore will transfer the case along with the report to the proper officer, who initially assess the goods and thereafter take up for adjudication. Therefore, this provision ensures that at least for the future there is some clarity that the DRI officers will not be responsible to issue note, or will not be empowered to issue notices, and nor will they be empowered to adjudicate or decide those show cause notices. This will only be for the future. Therefore, it will not be for the past. This new section will only take effect for the future and will not cover up the past periods. Past periods, the amendments made and the validation would be likely to be taken care of. Another change that has been made is under section 14, whereby the intention is to basically tackle the menace of undervaluation. In terms of this new clause that is inserted, the board has been empowered to cast additional obligations on the importers in respect of class of imported goods, where the board is of the view that the value which is being declared is not correct, considering the trend of the declared values or other relevant criteria. Then the government in this case will have to notify the class of imported goods and the information to be provided at the time of assessment. This will be in terms of the second provision, section 14. The effect of this is that the government, in terms of the valuation rules, would be empowered to cast additional obligations on the importers to furnish relevant information on the method of value, on the value adopted by them, to consider and also to ensure if that is not underdeclared, and therefore they do not go ahead with increasing the value of the goods. So this is a power which has been now given to the government in terms of section 14. The board is empowered to get additional information. One more change, this is again in terms of the WTO laws, is an amendment to the customs advance rulings. Now, the advance ruling has now been made valid for a period of 3 years. Once issued, it will be valid for a period of 3 years if there is no change in law or facts. What happens once the 3 years period is done? Whether this will ensure that the assessee will have to approach the advance ruling authority every time after the expiry of 3 years. According to us, this is a provision which is in vogue in the other countries also. The WTO also recognizes such validity. Normally what happens is, if an advance ruling is to be sought under the customs law for a proposed import which is happening, if an already ongoing import, there is no procedure for applying for a rule. Therefore, we do not see much of an issue in regard to this validity and keeping at least some certainty to the advance rulings which are given for a period of 3 years. One more important change is that currently, if an advance ruling application is filed, there is a time limit of 30 days within which you have to withdraw the application if you do not want that ruling for whatever reason. Now this period has been extended, so there is till the time the advance ruling is pronounced, an application filed, if an assessee does not want to pursue the advance ruling application, he can withdraw that application in terms of the amended provisions. This is a welcome change. There was earlier a restriction, there was delay which is being taken by the advance ruling authority to pronounce its rulings. So assessee could not have withdrawn their applications. Now this provision at least gives the power to the assessee to withdraw it till the time the advance ruling is pronounced. This is another welcome change. One more important change, I don't know if many of you would be aware of this scenario, where now you get a lot of information about the imports and exports that are happening, including the details of the importers and the exporters. And there are a number of third-party agencies which are selling this import-export data with an aim to protect the data. Now there has been an insertion of a new section 135AA in the Customs Act, whereby the value or classification, anything relating to value or classification of the goods, export, quantity of exports or import goods, the details of the importer, etc. If anybody publishes some information without authority of law, then such persons will be liable for imprisonment up to 6 months or fine or both. The term expression publishes here includes reproducing the information in printed or electronic form and making it available to the public. This is in terms of the recent data protection bill, which echoes similar sentiments on data protection. This is in fact a welcome change. There have been a number of instances where agencies are trying to derive mileage out of publishing information about the importers and exporters. It was freely available. There are no restrictions in place. This ensures that these people who are publishing these data without any authority of law would be liable for imprisonment or punishment. Now we come to the proposed changes in the IGCR rules. If I request my colleague Kali Rajan to take it over from here, I'll interfere whenever it's required. Thank you, Kali. Please take it over.
Thank you, sir. Good afternoon, sir. So I start with what are the amendments which is brought into the IGCR rules. The central government basically with the aim to give automated system, end-to-end process, all the procedures which is prescribed in IGCR rules. The central government has amended the IGCR rules 2017 by the IGCR rules amendment rules 2020-22, which would come into force on 1st March 2022. The entire processes, what are all the procedures which is prescribed in the current IGCR rules will be which are all presently being followed by which are all presently done manually or through the email or some system automated system. In future, all these intimations, approvals, and submission of returns, all those things will be going to happen through a digital platform. It may be a ISK portal. A new module may be generated by the customs for the purpose of IGCR rule compliances. So we know that there was a provision for or getting a permission from the jurisdictional customs on this annexures, we call it, which is prescribed under Rule 5. So those are all done away with. All these approvals and permissions will be given only online only. And one major change vis-a-vis the past and present is there was a provision under Rule 4 of IGCR rules for submitting an intimation, one-time intimation for before availing any customs exemptions. But hereafter, in addition to upon submission of these details about what is the exemption which you are going to claim and what is the exemption where these goods are going to be, the exempted goods are going to be processed, which factory, where is the location of this factory. So upon submission of this intimation, a unique number, that is the import of goods at concessional rate identification number. That number is going to be generated in the Igcr portal itself, which that number should be mentioned in the bill of material. That's one of the changes which is proposed. And they use the one word acceptance. Earlier, this rule 5 it says only for intimation. Rule 4 as well as rule 5 says rule 4 says about intimation, and based on that intimation itself, the intimation which is submitted to the jurisdiction customs itself will it's sufficient for claiming any exemption. Now it talks about something called acceptance. We don't know whether this the jurisdiction customs will give acceptance through this Igcr product. That is to be wait and see. And as per the IGCR rules, we know that there is a continuity bond to be executed, and as per this new provisions, this continuity bond also will be provided and maintained in the Igcr portal itself. All the debits and credits, it seems it's going to happen through Igcr portal. Presently, the rule talks about only debiting whenever there is a imports, but it doesn't talk about recredit. That the one thing the government should come out and explain. I mean, clarify. And another thing is, earlier we used to submit a quarterly return for what about the consumptions, what is the imports, those things. Hereafter it will be monthly, and that is also to be submitted only online. We need not to submit any manual returns either through CD or by printouts. So it will be through Igcr portal, it appears. And all these movement of goods, one of the change which is brought in, all the movement of goods, they given very clarity about what is the documentation we need for sending a goods for job work, imported goods for job work. And it says the invoice and e-way bill, e-way bill challan. So what are the GST documentation that is applied for this IGSCR rule complaints also when the goods are moved from one unit to another, or from the importer to a job worker location. But one condition which is imposed is the goods should be brought back within 6 months. Though GST law provides different timelines, but IGCR rules provides for 6 months. So those goods imported should comply with the 6 months timeline. And one more clarity. Earlier there was no clarity whether the goods should be used within 6 months or not. Only the provision which talks about the imported goods can be re-exported if it is found defective or unfit for use within 6 months, or it has to be sold within DTF or within 6 months on payment of custom duty. Now there is one more clarity: is the good should be used, otherwise it should be disposed of by way of re-export or selling it in DTF. That's one clear provision is given in this new IGCR rules. That is with respect to this IGCR rules amendment. We see the next one more welcome clarification which is issued by this board as part of this budget proposal is clarification on a social welfare surcharge issue. As we all know, this social welfare surcharge is calculated at the rate of 10%, basically on the basic custom duty value. There were disputes, especially many companies received summons and notices from the DRI to explain why this SW should not be collected or demanded when they are not paid, when their custom duty is exempted, especially for the export-oriented units and all. This issue triggered because of a decision of Honorable Supreme Court in the case of a Unicorn Industries. Wherein it was held that the custom exemption to the basic custom duty, it doesn't mean that it is exemption from other duties or cesses. In light of this solely taking on that ground, on field also there were many investigations why when the custom duty, especially BCD for EOUs is exempted under 52 or 2003, or free trade agreement exemptions, or the advanced exemptions where it all gives exemption only to the basic custom duty element. Why not the SW should not be separately demanded on the notional custom duty which is otherwise payable on the exempted value? In this line, the board very clearly given a clarification saying, in case the aggregate duty, customs duty payable becomes nil in view of any exemption or any other reasons, automatically the SW's payable also will not be payable. So that is the one welcome clarification which is issued by the board. This may resolve many issues, or at least for the future. But it is not. It's one thing which is silent. Is there is one more unresolved issue maybe. In case the duties are debited in the scripts, basic custom duty is debited in the script, whether still SW is payable, because if you see the exemption notifications, it uses the expression exemption when the duties are debited and scripts, it means it's exemption. because of that expression, there can be a issue on only a continuing issue with respect to payment of duties through the scripts. And one more also, because it's a clarification in nature, it should have a retrospective, but still, that one open question is there. Will the department will short close their pending investigations, or what will happen to present ongoing investigations? That is one issue which is. And this one more is, though this was this is only in finance minister's speech. It is nowhere there in the ACZ Act or in bill or notification or circular. This is, as of now, it is only in the form of a finance minister's speech where she mentioned that the ACZ Act will be replaced with a new legislation because this legislation came 2006. After that, there were many changes, including the GST. The entire tax regime itself is changed from central taxation service tax to GST. In order to cope up with all these changes, moreover, to be export oriented, they wanted to shift to employment oriented. So, there is a committee also formed to examine on this ACZ provisions and to suggest how best the ACZ Act can be revamped and then to make it employment centric. In these lines, we may expect the ACZ Act to be replaced with a new legislation that may be expected in the month of September 2022. One aspect is to give impact of these amendments and changes in the taxation provisions. Another aspect is to give a customs administration of SEZs. Presently, SEZs are being administered by the Jurisdictional Development Commissioner along with this SEZ portal. So the department, the finance ministry wanted to have customs administration of SEZs through a IceGate portal, maybe. Instead of we are presently filing bill of exports and shipping or bill of entry for supplies or receiving of goods from SEZ. Those are all happening presently through the SEZ portal, SEZ online portal. So those things will happen from IceGate portal instead of doing it. So these imports through SEZ also will be meshed along with this normal imports and with risk-based checks, as happens presently for the imports through the customs ports. The above are major changes with respect to the law, especially rules and regulations and law. There is some revamp or the major modification, or actually they even coined the new name tariffication of exemptions. So those are all. We wanted to simplify the customs tariff structure as well as to give a rate in a very simplified manner and phase out many exemptions which is not applicable for the current date. So all these revamping activities is being carried out as part of this present budget 2022. The budget 2022 tries to make some structural changes in the customs tariff itself to make wherever there is unconditional exemptions for a product, they wanted to stop or be discontinue to give exemption in the form of a notification. These are all brought into the tariff itself. That is what even the new name, the new word is coined as a tariffization of exemptions. All these unconditional exemptions or concessional rate of duties which were there will become part of the tariff itself. So that will come into effect from 1st May 2022. So one thing, when it has become a tariffization, we can have some stability on these exemptions. So it will not be withdrawn or take away all of a sudden by another notification. In order to amend the customs tariff, another bill to be introduced. So it's a long run process. So we can have some stability once the when these exemptions are brought as a part of the tariff itself. Especially this textile industries exemptions are brought from 50/2070 to or into this tariff itself. So in line with this, there are so many tariff entries itself being inserted. There are many entries, especially for the textile industries. And whatever the post changes in the tariff changes is whether majority of the changes doesn't has any change in effective rate. Either it is exemption is being withdrawn and then brought into tariff, or some exemption entries is taken from one notification to put in part of another exemption notification, concession notification. There are few entries where there is a change in effective rate because the government wanted to, it appears like they wanted to focus more on manufacture. So giving exemption to a final product is being withdrawn. It's mainly the exemptions given for the parts and raw materials, which is used for manufacture of the final product, as well as for the capital industry. Mainly the capital industry products for the project imports and all. The exemption has been withdrawn or reduced. More is given for the parts and components, especially with the objective of Atmanirbhar Bharat or Make in India objective. And some changes which is brought in the tariff is to give a sunset date. As we know, this last budget, when the Customs Act, in the last budget, there was a proposal like Section 25(4)(a) was inserted to say any conditional exemption will have a limited validity period. That's 2 years. So in case the exemption is not withdrawn or not modified before that date, it will have automatic expiry. So to give effect to those amendments, now the customs notification presently gives sunset clause for many notifications, which will be for another 1 year or 2 years. This is also given as part of the notification itself. So all these notifications to be read carefully to see what's the sunset date for the particular exemptions. In the paucity of time, we are not discussing in detail what rate, like which product is, because it's a very wide variety. Majority of the entries is changed, but there is no net effect, or the effect is seeing only from March 22 or May 22, or even after 1 year or 2 years. All these changes is going to affect only in the future, but not immediate. So we are not discussing those aspects as part of this tariff changes. One more aspect they brought in is the phasing out of project import benefits. So as the objective of government is to give boost to majority of the domestic manufacturers, domestic capital industry, to have a better footing. The concessional rate which is given under the project import benefit is being withdrawn, or it's going to be proposed to be withdrawn. That is only from October 2022. So from up to 30th September 2022, the present situation will work. But from from October 2022, the concessional rates, basically exemptions and concessional rates given for these project imports, especially main equipments, capital assets, those things will attract us uniform custom duty rate of 7.5%. For example, presently the power projects, which is attracting a 0 or 2.5 or 5%, it will attract a one rate of 7.5% from 1st October 2022. Similarly, for coal projects, gas projects, and other projects like a metro rail project or solar power projects, those are all will have an impact from 1st October 2022. We said there is a change, but what is the transition provisions given? Is in case a new project is being registered, in case the contract is going to be registered on 30 September, after 30 September 2022, that is treated as a new project. For those projects, the exemption will not be available. So the rate of BCD will be 7.5%. So whatever the projects already registered before September 2022, that will have a concessional rate up to September 2023. That's 1 year transition period is given. And by way of giving amendment to the notification number 50/2017 customs, that's the general exemption notification, that is being amended to prescribe what are the transitional provision. So from September 2023, all projects will get a one uniform rate, that is 7.5%. That is prescribed in the tariff itself. So there is no, it's not arriving, the 7.5% is not coming from any of the notification. It's in the customs tariff itself. So tariff rate will be applied unless any other notification comes in and gives another different rate. Another,
Khalid, does it mean that in respect of projects which are there in the pipeline and the participants are in the process of finalizing the investments, considering situation to be slightly better now as compared to what it was in the last 2 years or so, they will need to ensure that the projects are registered under the project import regulations on or before 30th September 22, so that they are eligible to get the lower rate of BCD 1. And it is not only sufficient if they get it registered before 30th September to be eligible for the benefit. They will also have to ensure that the goods will have to be imported before 30th September 23, or can the imports happen subsequently also?
So it's a good question. The imports can happen after 2022 also, September 2022 also.
23.
But,
Before
it's up to
23, is it?
before no sir. The projects registered up to 30th September 2022. The import can happen up to 30th September 2023 with a concessional rate, which is
Correct.
perfectly
After
available.
that, if imports are happening, then there will be a normal rate of
Normal rate of
7.5%.
7.5% will attract. Yes.
So therefore, the amendment here will only ensure that wherever anybody is looking for getting themselves registered under the project import regulation, they must do so before 30th September 22. If they don't, if they are not able to register the project before 30th September 22, then they will not get the concessional rate of duties.
Correct.
And even after they register, they must ensure that within 1 year period, they are able to import the good. This basically is to take care of the government's again objective of Make in India, encourage more manufacturing in India. So the participants, maybe they have to note down these crucial dates. One is to get the project registered. Two is to ensure imports happen within 1 year period before 30th September 23.
So and
That is how
one
it
more
has to
thing
be looked at, no?
yes, there is.
And any project which is getting registered after 1st September 21st from 1st October 22, they will not be eligible for the concessional rate.
Correct. So they will be required to pay BC at the rate of 7.5% at the tariff rate.
5%.
Normal tariff rate. And one more aspect also, because these are all mainly projects specific. So whenever they are placing bid for any tenders, these dates and clauses to be kept in mind very carefully, because in future if the rate increases, their bid price cannot be increased, or they have to see how it's.
Correct. If there's a delay, then they'll have to factor this additional duty which is payable as part of whether it will be a big cost for them if it's going to be all inclusive. Because I will be bidding now, presuming that there will be no customs duty and it will be an inclusive price. And if customs duty is supposed to be paid extra subsequently, then that's going to be a big cost.
Yep.
Okay.
And one more concept which is brought in is a base manufacturing program. This is introduced with the objective to promote domestic manufacture of electronic items. There are 3 identified products identified by the government, and it is to ensure Make in India and Atmanirbhar Bharat scheme. So with this, it aims to provide a easy access to raw material that is at a concessional custom duty for promoting a domestic electronic manufacturing and increase in export of value-added products. The government seen that there are huge exports of these products, electronic products, wearable devices. It's called a smartwatch, hearable devices. So for all Bluetooth, headphones, or speakers, those kind of hearable devices. The hearable device is also a new word which is being seen in the present budget. Like tarifization of exemption is the one word. And second thing is like hearable devices. And similarly, smart meters. These 3 products, the government come out with a base manufacturing program. So wherein they will be giving a concessional custom duty for a raw material, while the finished product will attract a higher rate of duty. One of the product is the wrist wearable devices. That's they call it the smartwatches. So the government has given a concessional rate of BCD for parts. Where, for example, a printed circuit board assembly, which is falling under 8517, which is presently nil. It will be for the financial year 2023, it will be nil. And from 23-24, it will be 10%, and 24 to 25, 15%. So we know the rate well in advance also for planning and other things. And the rates will be gradually increased by 5%, 5% to 10, 10 to 15. And at the end, it will go to the tariff rate. At the end of after 3-4 years, it will become a tariff rate. But the final product, which is a wrist wearable devices, that will attract the tariff rate of highest, like 20%. For example, wrist wearable devices that attract 20%, that will continue to be 20% till 4 years, up to 24, 25, 26. But whatever the components or raw materials which is prescribed in this notification, if you import, it will get a reduced rate, concessional rate. This PMP program is subject to condition that the importer follow the conditions prescribed under the IGCR rules. That is Import of Goods at Concessional Rate of Duty Rules 2017. And this comes from the notification number 11/2022, read with the 15/2022. And another scheme is base manufacturing program for hearable devices. So presently, these hearable devices attract the custom duty at the rate of 20%, 15%. That will be increased to 20% from 1st April 2022. It's already done. Only the effective date is given. From 1st April 2022, the rate of VC will be 20%. But the parts, if you import, that will be concessional rate. So what is the hearable devices also defined in the notification itself. That is a true wireless stereo, headphones, earphones, or similar devices that's being capable of connecting through a wireless medium. Same like a portable speaker also. So speakers and headphones which are able to capable of connecting through a wireless medium, then this exemption, then that will be treated as a hearable device, and they will get a concession. The parts will get a concessional rate of custom duty, while the final product will attract a higher rate of duty. For this program also, the importer should follow IGCR rules for import of the parts. And one more aspect is the effective rate prescribed for these products as part of the 15/2017 earlier, like before this budget, was also omitted and brought into this notification. So one point to be noted is, so we have to look out for these speakers and other speakers and hearable devices. You have to look for this notification for the exemption or concessional rate for March, April, February, and March, because these are all withdrawn or omitted from the 15/2017 and brought into this notification. Another product which falls under this PMP programs is smart meters. Similar lines, smart meters falling under Chapter 9028 will get a concessional rate. These all from customs. Right? I request Mr. Bridges to deliberate on GST.
Thank you, Rajan. Good evening to all the participants. I just project my screen 1 second.
Yeah,
I hope the screen is visible.
yes,
So
please.
under GST, there was no announcement in the budget in terms of the amendment that is proposed to be brought in, but there are some changes in the finance bill which may have implications in respect of the input tax credit, etc., which we'll discuss in some time now. So basically, we've covered the GST related amendments proposals into 4 broad categories. That is input tax credit related amendments, the relaxations in the time limit for various forms and returns, and other returns related amendments, and the other end proposals which are brought under the miscellaneous category that we'll be discussing at the end. So to start with the input tax credit related amendments, Section 16 is amended to provide for an additional condition. Section 16(2)(b)(a) is a new entry that is being introduced to lay down additional condition for taking credit. 16 itself was introduced to lay down certain conditions subject to satisfaction of which the credit can be availed. So 16(2)(b)(a) proposes to link the credit based on certain restrictions which will be prescribed under Section 38. 38 again is a new section which basically provides various conditions. 38 was earlier there as a part of the Act, which under the earlier proposal provided for furnishing of GSTR2. Since GSTR2 and GSTR3 have been done away with, Section 38 is now covering. It is substituted. It is proposed to be substituted to give validity or enabling provision to Form GSTR2B, which we are already using on the portal now for availing credit based on the information furnished by the supplier in his GSTR1. So Section 38 is going to be substituted to give backing to the statement in Form GSTR2B, based on which the information in respect of input tax credit may be prescribed. So 38 is basically divided into 2 parts. it will give the details of GSTR 1 related details based on the amount which is available as input tax credit, and the other conditions based on which the credit can be restricted. So section 38(2) is proposed to be introduced, based on which it says that the ITC would not be available wholly or partially by the recipient based on certain categories. There are 6 broad categories or nature of transactions on which the credit may be restricted. We've listed down all the 6 conditions here, 6 type of transactions here. First being registration related, the restriction based on the registration of a person. If a supplier has been newly registered, then the credit may be restricted up to a certain time limit as they would prescribe under the rules. So for example, we procure goods from a newly registered person, then the rules will prescribe certain time limit after which the credit can be taken, so that there is no default on the supplier or newly registered supplier for payment of taxes. Second condition is relating to payment of taxes. If there is a default in payment of taxes and such default continues beyond the prescribed period, then the credit may be restricted. Another issue based on which the credit can be restricted is if the amount of output tax as declared in GSTR 1 is higher than the amount of tax paid in form GSTR 3B. So if the tax is short paid, then the credit can be restricted in the hands of the recipient. Similarly, in terms of the input tax credit admissibility, if the supplier has taken input tax credit in his form GSTR 3B more than what is prescribed or what is eligible under form GSTR 2B, then there may be a restriction on the recipient of such supplier to take credit. And this is subject to certain prescription which will be provided in the rules. That is, it says which is in excess of the prescribed limit, both in terms of the mismatch between GSTR 1 and 3B. Another condition is in respect of the limit which is prescribed under 4912. This is a proposed amendment to section 49. We'll come to this in a while. But if there's a violation in section in complying with section 4912, then the recipient may be there may be a restriction for the recipient to take credit of the tax discharged by the supplier. And the last, it says that the credit can be restricted by other prescribed class of persons. So there is a possibility that the government will prescribe certain class of persons, the supplies from which are not eligible as credit in the hands of the recipient. So these are only there as a proposals which should be brought in the law. After it is amended and provisions are given effect to, there may also be a amendment to rule 60 of the CGST rules to prescribe these conditions, based on which the restriction would be given force. So those were some of the conditions which were prescribed under section 16 read with section 38. In addition to that, there's another provision, section 41, which earlier provided for a provisional claim of ITC. This also is proposed to be substituted. This amendment is now not on the basis of provisional claim of ITC, it is based on the self-assessment availment of ITC. So what it prescribes is that if a supplier has not paid taxes on the supplies made by him, then the recipient will have to reverse the credit based on account of non-payment of tax by the supplier, and the payment has to be made along with interest. Also, it prescribes that if the supplier has paid taxes subsequently, then the recipient can take credit. There are some ambiguity in respect of this condition. Ravi sir, if some of the conditions that are prescribed in section 38 is already taking care of non-payment of taxes, then what was the requirement of bringing these conditions again under section 41? Would that not be a double restriction?
Maybe only to ensure that the compliances are made, and then empower the government to take back the amount credits otherwise are not available.
Okay.
It's basically maybe to take care of the pending litigation. Number of matters are also pending now, that you cannot go after the recipient for non-payment of tax by the supplier when everything has been complied with.
Yes, sir. Under VAT, we had this restriction, and Delhi High Court had given a favorable judgment to say that recipient cannot be held responsible for non-compliance of the provisions by the supplier. So I think this may be to take care of or to give clear enforcement of.
Yeah, that is an issue there in the earlier regime. Most of the acts ensure that the if at all any liability is there, it has to be paid to the person who is otherwise liable to tax. So they could not go after the recipient who has taken credit to deny the credit on the ground that tax was not paid to the government. In fact, the one of the main reasons why this provision is specifically been brought is now the government is wanting to empower themselves to recover or not to suffer because of non-payment by the recipient, by the suppliers, and ensure that the recipients also put in place proper systems to ensure that their suppliers are paying tax to the government. Ultimately, that burden is being shifted to the recipient now, that if I want to take credit, I ensure that my suppliers are also discharging tax properly. That may be
This
one
may
of the
not be
reasons
available.
that are there. And yeah, unfortunately, number of matters are still pending in the courts. We'll have to see whether these provisions are going to be challenged. That the government should go after the person who is otherwise defaulted and not to come after the genuine or a bona fide assessee who's purchased and who is also paid the value of tax and the supply to that supplier. If that person has ran away, he is not traceable, then it's for the government to put in place proper systems in that regard. The one problem here would be that it only says that if I as a supplier delay payment and you are a recipient and you take credit, and you reverse it along with interest. If I discharge my liability to the government, then what happens to the interest that is paid by you? When I
Yes, sir,
delay the payment, I am required to pay tax along with interest. They also have to recover interest from you and then only give you the credit back. What happens to the interest in those cases? That is another aspect that needs to be taken care of.
Against the same transaction, the interest payment is collected twice.
It looks like government is looking at as many avenues as possible where they can ensure or recover the amount twice. They want to enrich themselves in whatever manner possible, and also 2-3 times. This is not the only provision. There are other provisions also which take care of similar situations. For example, if I delay payment to the supplier within 180 days, they want me to pay interest. If between the parties there is a transaction agreement that if there is a delay in payment, I pay interest to you on the receivables. Law section 15 says you add that and the value of the good supply and then pay tax.
Yeah.
So once they will add it as tax in your hands because you have received interest on delayed payment. 2, in my hands they will say you pay interest again. So those are all scenarios where the government is trying to enrich itself double times to ensure that they get more money. And instead of they putting in place a proper system and ensuring compliance by the suppliers and going after them for non-compliance, the bona fide purchasers are now required to face this particular problem.
Maybe we'll see how this provision comes out.
And definitely, it again going to be prone to challenge. Already there are petitions pending in different courts challenging the demands wherever there is payment made to the supplier and supplier is vanished. And all these are all genuine cases. It's a different matter where the government wants to put in place all these systems to prevent this bill trading and all those stuff. But that cannot be at the cost of bona fide purchasers who are making payments and procuring the goods and services.
Moving on. So this was the amendment relating to input tax credit. We'll now quickly cover the relaxation in time limits in various forms. There are certain provisions in the CGST Act which are proposed to be amended to prescribe a revised time limit. For example, section 16.4, which provided that ITC can be taken up to the due date of furnishing GSTR 3B for the month of September. It now says that the revised time limit would be November. Similar extension is provided for declaring the details of credit notes, any omission or rectification in furnishing form GSTR1, that is the details of output supplies, as well as the details of rectification and omissions in GSTR 3B under section 39.9. Also, if there's any omission or correct particulars to be covered in Form GSTR 8, that is for the e-commerce operators, all these time limits which were linked to the returns or forms to be filed for the month of September, the revised time limit would now be November 30th. One point to note here is earlier, if it was linked to the filing of Form GSTR 1 or GSTR 3B, the dates were varying. For example, GSTR 3B, the due dates were based on the turnover and the place of business. It could be 20th, 22nd, or 24th. Now the date is absolute, 30th of November. And it doesn't say the November month's return. So it has to be filed at the time of furnishing October month's return, whether it is 20th of October, 20th of November, or 22nd or 24th of November, depending on the due dates. The relevant information have to be furnished. So effectively, the extension is about a month now, once these provisions are enacted. The next set of amendments is in the returns. There's not much. This is basically an amendment to section 37 and 39. 37.4 would now prescribe that GSTR 1 for one tax period will not be allowed to be filed unless the previous months or previous tax periods GSTR 1 has been filed. Similarly, a person will not be allowed to file GSTR 3B for that month if he is not furnished GSTR 1 for that period. So the filing of GSTR 1 and 3B would be sequential now. There are some omissions in the Act, particularly the provisions relating to matching, reversal, and reclaim of ITC. Section 42, 43, and 43 would now be omitted from the Act because earlier, as envisaged, GSTR 1, 2, and 3 was proposed. Since all that has been done away with, the relevant provisions enabling those flow of information from supplier to recipient, verification, and reclaim of credit, all those provisions have been done away with. So no more two-way communication. It has to be done based on the earlier discussed provision, that is through GSTR 2B. Coming to the last part of the discussions relating to GST, miscellaneous changes. Section 29(2) is proposed to be amended. This deals with cancellation of registration. For the composition dealers who were earlier required to file quarterly returns, the returns is now on an annual basis. So if a composition taxpayer fails to furnish his return within the prescribed time limit or up to 3 months from the prescribed time limit, his registration is liable to be cancelled. And for other registered persons, if they don't file their returns within the, earlier it said that if you don't file returns within for a continuous period of 6 months, then there may be a cancellation of registration by the proper officer. Now this period would be prescribed by the rules. So the amendment to section 29(2) would say that the non-furnishing of return for such continuous tax period as may be prescribed would lead to cancellation of registration. Section 49(2) of the CGST Act, this is an important amendment. Section 49(10), 49(10) earlier allowed for transfer of balance in the electronic cash ledger between one head of tax to another head of tax or interest, penalty, or fees within the same GSTIN. This is being amended to allow transfer of balance in the electronic cash ledger from one person to another within the same PAN. So, for example, a person in Karnataka wants to transfer the balance in the electronic cash ledger to a person in Maharashtra. This can be done provided it is within the same PAN. There is a condition that they have prescribed that unless there is if there is any output tax liability, unpaid liability in the electronic liability ledger, then in such case the amount cannot be transferred. There is an ambiguity as to whether the unpaid liability will be on the basis of department's determination or would it be based on the self-determination. So on the portal, there's an electronic liability register. If there's any unpaid liability in that, only then the credit transfer of balance in the cash ledger would be restricted, not otherwise. We had discussed section 49(12) when we were talking about the amendment in section 38. 49(12) basically gives a legal backing to Rule 86B, which is already in force, which prescribes that you cannot utilize the electronic credit ledger balance beyond the prescribed amount. For example, for 1886B says that you're liable to pay the tax up to the maximum of 99% by utilizing the balance in the electronic credit ledger. So there are some exceptions to this rule. 86B provides that if you are a PSU, for the tax payment, income tax payment is beyond the particular threshold, then there may not be a requirement of discharging the amount by cash ledger. But to give a legal backing to 86B, Section 4912 is being inserted. Section 50 related amendments. Section 50 deals with interest, that is interest. Subsection 50 subsection 3 is being amended to prescribe that unless the ineligible ITC has been availed as well as utilized, the interest may not be payable. If the ITC is ineligible, IT is only availed but not utilized, then there may not be a liability for payment of interest. Also, this amendment is proposed to be made retrospective from 1st July 2017, and also the rate of interest under Section 50 subsection 3 is being prescribed at 18%, not 24%. So such amendment would also be made available to the IGST Act and UTGST Act. The states will also have to come with the amendments in their state GST acts. Earlier, this rate of interest under notification 13 of 2017 prescribed 24%. So some of the taxpayers may have paid 24% based on the insistence of the authorities. So it is to be seen if the the interest at the rate of 24% has been discharged, then whether the same can be claimed as refund by such taxpayers. Another issue relating to the refund. Section 54 deals with refund. 54.2, which specifically deals with refund of the balance in the electronic cash ledger. Earlier, it was linked to filing of GSTR 3B. Now that linking of GSTR 3B and the refund is no more, because it was earlier envisaged that once you file GSTR 3, the refund balance in the electronic cash ledger would automatically be refunded, or the application for refund would automatically be filed based on what happens now for payment of export on payment of tax. So since 3B does not have the facility for sanction of refund, this would be separately prescribed in the rules. There will be a separate form for claiming refund of the balance in the electronic cash ledger. Section 54.10 amendment prescribes that the amount which is proposed to be claimed as refund can be withheld by the authorities. Presently, the option to withhold or recover the refund is only limited to unutilized ITC. So with the amendment to 54.10, it is also possible that the authorities can withhold the amount claimed as refund of tax paid on export of goods or services also. Next amendment, this is only a clarificatory amendment. And explanation B has been amended to prescribe the relevant date for claiming refund of tax paid on supplies of goods or services to SEZ unit of developer. Earlier, it was linked to the date of, there was no particular provision for claiming refund. So as a residual provision, companies used to claim refund based on the date of payment. This was creating a problem when companies were claiming refund of unutilized ITC, that is supplies made without payment of taxes. So now they have linked the relevant date based on the date of furnishing of GSTR 3B, so that there is a uniformity in the date for claiming refund. The relevant date would be based on the date of filing of GSTR 3B rather than the date of payment of tax. Some of the other amendment miscellaneous, this may be specific to certain sectors. 47.1 is being amended to prescribe late fee for e-commerce operator filers. So GSTR 8, if there's a delay in filing of the form, there may be a late fee which is prescribed. Also, another specific amendment relating to fish meal. Fish meal was exempted from payment of tax from October 2019. So this amendment is being brought in to give retrospective exemption for the period from July 17 to September 2019 for the product fish meal, which has been discharged. The refund may not be available if the tax has been collected. Another amendment is with respect to the grant of alcoholic liquor license given to some of the bottling companies. So any company that has discharged GST on the license given for supply of alcoholic liquor products, there was an a notification 25 of 2019 under section 7.2 which prescribed that these licenses neither qualify supply of goods nor supply of services. So this was effective from October 2019. This also has been given retrospective effect from July 2017. Here the tax was payable by the supplier under reverse charge. So here again the condition is that the refund cannot be availed if tax has been collected from the recipient. Here, since the tax would be paid by the supplier under reverse charge, there may not be a requirement of collecting tax from the recipient. So it is to be seen whether tax paid under reverse charge can be claimed as refund for the period from July 17 to September 2019. So these were the only amendments from GST perspective.
Brijesh, on the GST perspective, one of the crucial changes would be the amendments made to section 38, where the auto-generated statement will ensure that some of the credits are not going to the recipient on account of various reasons. Whether the registered person has defaulted the payment of tax, or that the tax paid by him is not commensurate with the amount payable through cash or credit utilization of credit. There's a difference between GSTR 1, GSTR 3B, etc. Unless some system is put in place or proper guidelines are given, and this is going to be a big problem for most of the recipients. Because many a times we see that credits are not allowed or allowed to be moving into the credit ledger, and reasons are not known, and you keep running here and there, nobody knows what is the reason. Similar problem that we have with the blocking of the credits also. So that's going to be a big problem. 38. So I think appropriate steps must be taken to ensure compliance by the suppliers, and then therefore ensure proper flow of credit in the auto-generated statement. Thank you, Brijesh and Kali. Now maybe we can move to Neetu for the changes in the direct tax law.
Thank you, sir. The direct tax provisions have also seen a number of changes in the current budget. The changes are there in the substantive provisions as well as in the procedural provisions. We will quickly run through some of the major changes. One of the first provisions which have come in is regarding the disallowance of expenditure in relation to exempt income. The section 14A of the Income Tax Act provides that no deduction will be allowed in respect of any expenditure incurred in relation to exempt income. A question used to often arise that what would happen in a case where there is no expenditure incurred in a particular year, whether the department can go ahead and make a notional deduction even in a year where no actual expenditure, where there is no exempt income, and therefore no expenditure is incurred in respect of exempt income. Courts had taken a favorable view in favor of the assessee that where there is no exempt income in a particular year, deduction cannot be made in terms of 14A on a notional basis. Now a clarificatory amendment has been introduced to provide that section 14A disallowance will apply even in a year in which there is no exempt income earned by the assessee. Even though this amendment is with effective from 1st April 2022, the memorandum says that this is a clarificatory amendment, and it's quite likely that department may apply this amendment even for pending litigation. Another important change in the substantive provisions which has been made with an object to overcome judicial precedents is with respect to expenditure under section 37. Section 37 provides for allowance of expenditure incurred, revenue expenditure incurred by an assessee in computing income under the head PGBP. Now, as far as pharma companies were concerned, where any kind of benefits, perquisites, etc., has been conferred on doctors or medical professionals in violation of the ICMR regulations, The question arose whether the pharma companies can claim expenditure deduction in allowance in respect of these expenditure. Courts had taken various views. There were recently decisions which held that expenses claimed part. Since these kind of expenses are not prohibited by any law, ICMR regulations are in any case applicable only in respect of the medical professional and not in respect of the private companies who are incurring these expenditure. So with a view to overcome this decisions, a clarificatory amendment has once again been brought in. A clarificatory explanation has been brought in. The explanation seeks to clarify that if any expense is incurred for any purpose, which is an offense under Indian law or outside India, then such expense is required to be disallowed. In fact, the memorandum goes one step ahead and also seeks to cover any expense which is incurred by the assessee to compound an offense under any law for the time being in force in India or outside India. Such expenses are also sought to be disallowed in terms of the proposed amendment. Even though here again the amendment is with effect from 1st April 2022, the department may very well claim that this amendment is only clarificatory in nature and may apply for pending cases as well. Another dispute was regarding the allowability of cess and surcharge as a deduction in computing the income under the head PGBP. There is a prohibition under section 48 from claiming income tax as a deduction while computing the income under the head PGBP. Now, question arose whether cess and surcharge, which are computed on income tax, can also be claimed as deduction or not. Courts had, in view of some old circulars or issued by CBDT, taken a view that cess and surcharge can be claimed as a deduction. However, relying on a Supreme Court decision, subsequently, tribunal had also taken a view that cess and surcharge being an addition to the income tax liability of the assessee, the same cannot be claimed as a deduction in computing PGBP income. And this position is sought to be reinforced by way of the amendment by inserting an explanation in section 40A2. The explanation clarifies that any sum paid towards cess and surcharge is to be disallowed. And this amendment is made retrospectively with effect from 1st April 2005, which happens to be the date on which education cess was for the first time imposed on income tax. Another very significant
Will this amendment result in reopening of assessments, at least within the time period where, because there are definitely, as the government itself admits, there are conflicting decision judgments on this point, and they have followed a recent ITT judgment to say that that lays down the correct law, it follows the Supreme Court judgment. Will this entitle them to reopen assessments within the time limit available, wherever
yes,
the deduction towards the cess has been allowed as expenditure?
Yes, this could be a case where the old assessments can, wherever time limits are still available, the department can reopen the assessment. Since this amendment is by way of a clarificatory amendment and also and a retrospective amendment, and the department is also relying on a Supreme Court decision in support of this particular amendment. So therefore, it's very likely that assessments may reopen within the time limits prescribed.
Correct.
Next is a beneficial amendment which has been brought in. Section 56 of the Income Tax Act provides for taxation of any amount which is received by an assessee without consideration. So taxation of gift or any amount received by an assessee exceeding 50,000 is liable to be taxed in the hands of the recipient. Now, there were various cases. There are several exceptions which are laid out to this provision. There could be, however, one of the exception which was not provided was cases where any amount is received by the heir or legal heirs of a deceased who has passed away during COVID. So there are several cases where gratuity or other benefits were granted to the relatives and in such scenario by an employer, and in such scenario whether the amount which is received by the family member on death whether such amount will take the color of income in the hands of the family member was a question. While these amounts were really in the nature of a gainfall and could not have been taxed as an income in the hands of the recipient, in order to clarify the position, now an amendment has been brought in, whereby any amount which is received from the employer would be exempt without any limit. And if it is received from any other person, the same amount will be exempt to the extent of rupees 10 lakhs, and provided the amount is received within 12 months from the date of the death. Similarly, amounts received for medical treatment of the individual or the family member is also granted exemption. This exemption is also with retrospective effect, which has been brought in with retrospective effect and is applicable from AY 2021 onwards. Another important amendment is in respect of section 43B, whether the deduction in respect of interest can be claimed without actual payment or not. Section 43B allows for expenses to be allowed only on the basis of actual payment. So where any loan or borrowing, any interest liability has been converted into loan or borrowing, a view had been taken. Section 43B clarifies that no interest will be, the conversion of the interest liability into loan or borrowing will not be considered as an actual payment, and hence will not be allowable as an expense in the year of conversion into loan or borrowing. Now the scope has been expanded. If the interest liability on a loan or borrowing is converted into debenture or any other instrument by which the liability to pay is deferred to a future date, even in such scenario, the conversion will not be considered as actual payment of interest. Now we will see a few beneficial provisions. In terms of the rate, there hasn't been many changes, except for the cooperative societies for whom a beneficial rate has been given. But as far as domestic manufacturing companies are concerned, the reduced corporate tax rate, which is available for new domestic companies set up, has been extended by 1 more year. Earlier, the benefit of concessional rate of tax was available only till 31st of March 2023. Now it has been proposed to be extended by 1 more year to 31st of March 2024. So in order to avail the reduced corporate rate, it is necessary that the new domestic manufacturing company should commence its manufacturing or production on or before 31st of March 2024. Similarly, in respect of startups, the profit-linked incentive under 80 IAC, the cutoff date was expiring on 31st of March 2022. It has been extended by 1 more year by 31st of March 2023. At the procedural front, there have been one major amendment, which is the option of filing an updated return of income. In a case where the assessee has filed original or belated return or a revised return, or assessee has not filed any return at all within the due date for filing of the returns, the assessee has an option to file an updated return of income. The updated return of income has to be filed within 24 months from the end of the relevant assessment year. The only condition is that when the assessee is availing of this option, the assessee, in addition to the income tax as applicable and the interest liability, is also required to pay an additional tax of 25% of the income tax and interest if the return is being filed within the first year. And if the return is being filed in the second year, then the assessee is required to pay as additional fee an amount equal to 50% of the income tax and the interest thereon. There are certain exclusions. In updated return of income is not available. This option is not available to the assessee in case of search and survey proceedings. Now, coming to TDS front, as in every year, there are certain changes in the TDS provisions as well. And one of the major change is with respect to the taxation of virtual digital assets. There was a lot of news regarding the taxation of cryptocurrency. The cryptocurrency bill was proposed in the was proposed in the session. However, it was not tabled. Now the budget has sought to tax cryptocurrencies under the name of virtual digital assets. So a new definition has been introduced in the Act to define virtual digital assets. Any digital as any information or code or number or token which has been generated through crypto mechanism is considered as a virtual digital asset. And it also includes NFTs and any other digital asset as will be notified by the central government. The central government also has the power to notify assets which will not be considered as a virtual digital asset. This assumes significance considering that the budget also says that RBI will be coming out with its own digital currency sometime during the year. So we have a provision for taxation of virtual digital assets. The taxation of virtual digital asset essentially consists of two provisions. Firstly, any income from transfer of a VDA is sought to be taxed at the rate of 30%. The Act also says that no set-off of loss or any expense will be allowed in computation of the income from transfer of VDA. Similarly, no carry forward will also be allowed. So it appears from the provision that there will be no intra-head or inter-head adjustment in computing this income. Similarly, no carry forward of any loss will be allowed, and any income which is arising from the transfer of VDA is required to be taxed at the rate of 30%. There are ambiguities regarding the characterization of the income and the manner of computation of this income. Only allowance which has been permitted in computing this income is the cost of acquisition of the asset. Otherwise, no other expense is allowed to be deducted. The benefit of indexation is also not extended in computing the total tax on digital on VDA. Now, coupled with this provision, we also have TDS on virtual digital assets. So this provision essentially requires to deduct TDS at 1% on any payment which is made for transfer of virtual digital assets. Where the payment is made to a resident, then the payer has to ensure that applicable taxes at the rate of 1% is being deducted on the payments which are made for the virtual digital assets. There is a threshold also specified in respect of these transactions. However, exactly how these provisions will operate is not clear. Primarily when these transactions of VDA, purchase and sale of VDAs generally takes place through exchange houses. And in respect of these exchange houses, where the transactions are taking place through exchange houses, who is liable to collect the deduct the TDS? Because in most of these transactions, the buyer would not know who the seller is and vice versa. So therefore, there are challenges in respect of actual execution of these provisions. Similar issues were there in respect of TDS on goods, purchase of goods under 194Q, as well as under TCS in terms of 206C. In both of these cases, the department had subsequently issued circulars clarifying that in case of exchange transactions, the TDS CCS provisions will not be applicable. The government has also, as of now, there is no clarity on the TDS provisions, operation of the TDS provisions as far as VDA is concerned, but there may be more clarifications in the days to come. Another TDS provision which has been introduced is the TDS on benefits or perquisites, which are being provided by a person to any resident. In such a scenario, TDS is again required to be deducted. Now, the one of the doubt which arises is what are the benefits and perquisites which have applicable in these cases. So the TDS on VDA as well as TDS on benefit and perquisite arising from business or profession. So this is not applicable to TDS on benefits or perquisites which are being paid to a salaried employee in respect of whom 192 and TDS provisions will apply. However, if any other benefit or perquisite is being made to any during the course of from business or profession, In such a scenario, the TDS under 194 R will apply. These provisions are to come into effect from 1st of July 2022 after the bill receives the assent of the President. Another very interesting change is regarding the amendment for a higher rate of TDS and TCS. You would remember that last year the government had brought in a proposal for higher rate of TDS and TCS in cases where the assessee has not filed the returns for 2 years preceding the year in which the tax deduction is to be made, and for which the time limit for filing the return has expired. Now, this requirement of 2 assessment years has been done away with. Instead, if the payee has not filed income tax returns in the assessment year, preceding the assessment year in which the return is being, tax deduction is being made, and the time limit for filing such return has expired, in such a scenario, TDS has to be deducted at the higher rate. So, or at 5%, whichever, so this higher rate will be double the rate of the TDS, or 5%, whichever is higher. There are also some amendments in respect of amalgamations. These are essentially clarificatory in nature. In case of business accessions, there used to be doubts as to who would file the return. Now this position has been clarified. It has always been the practice that a successor company, after the amalgamation comes into effect, files a revised return in respect of the period between the appointed date on which the amalgamation comes into effect till the effective date. Now this has been given a statutory backing, and the successor company will be able to file a return in respect of the period between appointed date and effective date. As for the transactions prior to the appointed date, the same shall be validly conducted in the name of the predecessor company, and after the predecessor company ceases to exist, these proceedings, any demand notice, etc., in respect of the proceedings will be continued in the name of the successor company. Another very important change was regarding the faceless assessment. So in October to November 2020, during the COVID times, we had the faceless assessment scheme coming into effect. All the assessments, reassessments were to be conducted by the faceless mechanism. However, there were a lot of disputes, especially petitions were filed for non-granting personal hearing. Personal hearing was not mandatory, even if the assessee requests for the same. Under faceless assessment proceedings, personal hearing was not granted. This was challenged before various high courts, and several high courts had taken favorable view. The petitions are pending in various high courts. In view of this, the faceless assessment provisions have been substituted. Under the substituted provisions, now the assessee has the opportunity to request for a personal hearing, and where the assessee seeks a personal hearing, he is required to be granted a personal hearing. There are several other changes in respect of search and seizure, as well as wherein one notable change being that the set-off of losses in respect of undisclosed income will not be permitted while computing the income. So similar changes has been brought in. So that brings us to the end of the presentation. There are certain other changes regarding section 148 as well, and the reassessment proceedings, but those are primarily increasing the scope of the department's power in respect of search and seizure cases, wherein the time limit as well as the procedure for reassessment has been expanded by way of these amendments.
Thank you, Neetu. Thank you, Neetu and Kali. Mr. Sundaram, we can open up for question and answer. There's Neetu one question in the chat box in the Q&A relating to as to whether reimbursement of vaccination cost, would that be treated as taxable in the hands of the employees? According to me, it would not be. It will be only the reimbursement of the expenses, and also I think the employer can claim expenditure deduction towards that expenditure.
Yes, sir, that is right, sir. The amended provisions will provide that any free expense which is incurred by the employer for the employee as well as his family member, both will not be considered as taxable income
In the hands of the employees, no?
in the hands of the employee.
Yes, any other questions? We are open for question and answer for about 5 minutes, then we can close. Mr. Uday or Mr. Sundaram, any questions? And if you can just open up for questions, or we close the session.
Sir, we can't find any other questions apart from asked from.
Yeah, if anything is there, if they come, they can mail it to you so that we can address them. We can close the
Yes,
session.
yes, definitely, sir. I'll share the details with the questions. We can reply back to them.
Thank you, ladies and gentlemen, for attending this another budget session. We understand that there have been so many sessions going on. We thank you for taking time off your busy schedule and being part of this. Hope we have been able to clarify as many issues that we have come across during our internal deliberations. Thank you for attending, and if you have any further queries, you can just mail it to ASSOCHAM or directly to any of us. We can address them.
Thank you, sir.
Thank you. Take care. Thank you. Bye.